Have you ever heard of those investing cliches that sound like real advice but aren't? You know, like sell in May and go away, or the trend is your friend. Or how about this one? The so-called 100 minus your age rule, which says you can figure out how much you should own in stocks by simply subtracting your age from 100. So if you're 65 years old, then you should probably have like 35% of your portfolio in stocks, right? Well, that's all a bunch of garbage. But right now I want to focus on the overall idea that the older you are, the less exposure you should have to equities. Is that really a true statement? Well, for someone who is approaching retirement, but not quite there yet, I'd say it could be a good idea to begin lowering their allocation to stocks. You could change the allocation in, say, your 401k to include a higher percentage of safer, non-volatile assets, thus lowering your overall exposure to stocks as you get closer to retirement date. That way, if the market just happens to have a bad sequence of returns early in retirement, you're potentially more protected on the downside. That's the whole idea, right? But it's at this point where the, quote, own fewer stocks idea as you get older might need to change. Once you start distributing money from your portfolio, retirement research now tells us that you actually may be better off with an increasing exposure to stocks, just kind of opposite of what we've learned as conventional wisdom. You do this by spending down these non-volatile assets in your portfolio first, where you aim to use a reserve of cash and bonds or bond equivalents to cover your spending needs for the first 10, 12, or even 15 years of retirement. By spending down this portion and leaving the equities alone for that time, assuming they grow, the percentage of equities you own goes up by default. We call this a bucket strategy, but you can call it whatever you want to. The point is that by slowly increasing the percentage of stocks in your retirement, you may be able to take advantage of what the market gives you. Remember, outcomes for 30-year retirement are driven heavily by the results you get over the first 15 years. So, if those first 15 are good, your equities will have grown, potentially giving you enough to get through the next 15 or so years. But if the first 15 years are bad, a rising exposure to equities is similar to systematically dollar cost averaging into the market, which may put you at a nice advantage for a potential recovery during the next 15 years. The bottom line is this. At Lucia Capital Group, we believe in looking at both conventional and unconventional wisdom to help our clients navigate through the retirement maze.